February 6, 2025. Nissan CEO Makoto Uchida walks into a private boardroom in Tokyo. Across from him sits Toshihiro Wibe, president of Honda Motor Company. The agenda? A possible merger, a lifeline for Nissan, now on the edge of collapse. But Uchida has other plans. He tells Mibe that Nissan is pulling out. The deal is off. 1 month later, Uchida resigns. Nissan's future looks bleak. How did it come to this? How does a global automaker end up facing bankruptcy, then refuse rescue when it's offered? To answer that, you have to go back to the late 1990s. Back then, Nissan was drowning in $32 billion of debt. Market share had collapsed. Earnings swung wildly. The Asian financial crisis of 1997 hit demand hard. Nissan, like its rivals, bled cash. Even Toyota felt the pressure. Then came Renault, buying a 36.8% stake and sending Carlos Ghosn to the helm. He promised to bring Nissan back to profit within a year and put his own job on the line. 5 factories closed, 21,000 workers were let go, consultants cut, and debt slashed. He pulled it off. Net profits swung from a $6.46 billion loss to $2.7 billion in the black. Ghosn saved Nissan once, but history would not repeat itself. By 2025, decades of missteps, pride, and missed trends put Nissan in a much deeper hole. The Honda merger was their last real chance. Uchida's refusal may have sealed the company's fate.
Carlos Ghosn didn't just pull Nissan out of bankruptcy, he made history. By 2005, he was running both Nissan and Renault, the first person ever to serve as CEO for 2 Fortune Global 500 companies simultaneously. Under his watch, Nissan surged. Then, in 2016, the company took another bold step, acquiring 34% of Mitsubishi Motors. This move created the Renault-Nissan-Mitsubishi alliance, giving them more scale and leverage against automotive giants like Volkswagen and Toyota. Nissan was riding high, and Ghosn sat firmly at the top as chairman. But the alliance's success wouldn't last. In 2018, the shock hit. Ghosn was arrested in Japan, accused of underreporting income and misusing company assets. He was promptly removed as chairman. As he awaited trial, Ghosn made global headlines again, this time for escaping to Lebanon, evading Japanese authorities. The fallout was swift and severe. Share prices of Nissan, Renault, and Mitsubishi all tumbled. More critically, the alliance lost its anchor. Ghosn had driven the strategy for over a decade, and without him, stability vanished. Mitsubishi distanced itself. Renault brought in new leadership, and Nissan? They drifted. Leadership instability followed as Hiroto Saikawa, Nissan's CEO at the time, was also caught in a pay scandal and forced to resign. The situation was rapidly spiraling. In late 2019, desperate for direction, Nissan's board unanimously chose Makoto Uchida as CEO. He inherited a company battered by scandal, with its stock price halved in just a year. The next crisis was already looming. Uchida's arrival came at the worst possible time. As he took over in October 2019, Nissan was still reeling from leadership chaos and falling stock value. Then, the world was hit by COVID-19. In the first quarter of 2020, Nissan's revenue plunged by 50.5%. The company reported an operating loss of $1.44 billion and a net loss of $2.67 billion. Nissan was back in the red. Fast. Faced with these mounting losses, Uchida launched a new plan, Nissan Next. The goal was clear, return Nissan to growth by the end of fiscal year 2023. But Uchida promised to do it differently. Focus on core strengths, pursue steady and profitable growth, enhance financial discipline, and revive the culture of Nissanness. He set hard benchmarks, a 5% operating profit margin, and a global market share of 6%. At the time, Nissan was nowhere close to these targets. The recovery plan was aggressive. Global production capacity was slashed by 20%. The product lineup was trimmed by 15%. 12 new EVs were launched ahead of schedule to capture the surging electric market. Management layers were cut, saving over $3 billion. Factories and staff were streamlined. The early signs were promising. For fiscal year 2021, Nissan posted an operating profit of $2.2 billion, its first year back in the black. Yet, despite the turnaround, the margin was only 2%, and Nissan's market share was still off the target. There was progress, but the company's situation remained fragile. Uchida knew the real test was yet to come. The path back to stability would prove even steeper than before.
Nissan's initial comeback appeared real. By 2022, operating margin had improved to 3.6%. In the third quarter of 2023, profits reached 478.4 billion yen, or about $3.3 billion, and operating profit margin climbed to 5.2%. Uchida's turnaround plan hit its financial target, at least on paper. But even with these results, there was no mention of achieving the 6% global market share. Then, the underlying cracks started to show. The trouble began in the US, a market Nissan depended on. The Rogue and Sentra, two of their most important models, suddenly piled up at dealerships. Usually, as model years shift, dealers run low on old inventory and new models arrive smoothly. This time, the transition between 2023 and 2024 models was bumpy. Inventory ballooned to over 640,000 vehicles, double the 2021 figure, with half sitting idle at dealerships. Desperate to clear backlogs, Nissan slashed prices and offered large dealer incentives. But this was only a symptom. The deeper issue was demand. Why weren't customers buying? Nissan had doubled down on electric vehicles, cutting hybrids from their US lineup, even discontinuing the Rogue hybrid in 2020. Meanwhile, demand for hybrids exploded. In 2023, US hybrid sales jumped 53% to nearly 1.2 million. Globally, hybrids topped 4 million, outpacing EV growth. Plug-in hybrids surged 65% in 2024, while battery EVs grew just 23%. Nissan had missed a crucial shift. With no hybrids to offer, the company was left exposed, caught between declining combustion sales and an EV market that wasn't growing fast enough. The results of Nissan's strategic missteps were devastating. By early 2024, despite aggressive discounting, demand didn't recover. Cars were selling at almost zero margin. Operating profit plummeted 99%, dropping to just 995 million yen, or about $6.5 million. The impact was immediate and severe. Over 9,000 jobs cut worldwide, factories scaled back, and dividend payments suspended. To stay afloat, Nissan began selling off valuable assets, including its entire stake in Mitsubishi Motors. Even as losses mounted, CEO Uchida attempted to reassure the public. At a press conference, he insisted, "These turnaround measures do not imply that the company is shrinking. Nissan will restructure its business to become leaner and more resilient." But the message didn't convince investors or industry analysts. The numbers spoke for themselves. Internally, morale sank as cost-cutting accelerated. For a company once hailed as a symbol of Japanese industrial resilience, this was a dramatic fall. The once ambitious Nissan Next plan had run its course. The global auto market was shifting, and Nissan found itself on the outside looking in, unable to compete with rivals who had embraced hybrids or had stronger balance sheets. With cash reserves dwindling and a weak model lineup, Nissan urgently needed help. But few expected the next offer of salvation to come from a competitor. Not from longtime partner Renault nor Mitsubishi, but from Honda. As Nissan's financial crisis deepened, talks of a merger with Honda began in late 2024. For Nissan, this could have been a lifeline. Honda, Japan's second-largest automaker behind Toyota, had a market cap near $45 billion, while Nissan was valued below $10 billion.
Honda's business stretched far beyond cars, motorcycles, ATVs, power tools, marine engines, even private jets. The proposed merger aims to create a new automotive giant able to compete with global leaders like Toyota, Volkswagen, and the fast-rising Chinese brands. Honda CEO Toshihiro Miebi was clear about his motivation. The rise of Chinese automakers and new players has changed the car industry quite a lot. Chinese companies like BYD were already surpassing established giants in global EV market share. If Honda and Nissan merged, they would rank third worldwide. But the balance of power in negotiations was lopsided. Honda was financially healthy and diversified. Nissan was desperate. Internal reports from early 2025 revealed the cracks. Honda pushed for aggressive cost cuts, including closing some Nissan plants, something Nissan's team called politically sensitive. Honda executives began describing Nissan's management as slow and inflexible. Negotiations hit a wall when Honda revised the deal's terms. Instead of an equal partnership, Nissan would become a subsidiary. The logic was blunt. Nissan's sales, costs, and debt had fallen too far behind. For Nissan's executives, this was an insult to the company's legacy and pride. The original vision of a merger of equals was gone. On February 6, 2025, Uchida met with Miebi and officially ended the talks. The deal was dead. Nissan's share price collapsed 80%, falling below $3. Honda called the outcome disappointing, while Renault criticized the terms as a takeover without premium. With the Honda deal gone, Nissan faced the consequences alone. Uchida resigned just 1 month after breaking off the negotiations. The company was left with few options. Financially, Nissan reported its first operating loss in more than 4 years, minus 79.1 billion yen, or about minus $534 million. Factories stood on the brink of closure, and the threat of bankruptcy became more real than ever. Internally, chaos mounted. A new CEO took over and quickly announced over 20,000 layoffs, double the previous wave of job cuts. Nissan scrambled to unveil 3 new EV models to signal hope, but the market wasn't convinced. The global EV slowdown, mounting tariffs, and lingering supply chain issues made recovery unlikely. Debt remained overwhelming. Nissan owed $50 billion, yet showed no sustainable profit. MacroAxis, a market risk platform, assigned Nissan a 100% probability of bankruptcy. Shareholders, employees, and industry watchers saw little path forward. Meanwhile, Honda moved on, while Renault, still Nissan's largest shareholder, openly criticized the failed deal. Nissan's reputation as a survivor of past crises was fading. The company's choices had left it vulnerable, alone, and shrinking fast in a brutal global market. Nissan's collapse now seemed less like a possibility and more like an inevitability. The loss of the Honda deal underscored a harsh truth. Pride and indecision can be fatal even for industry icons. Nissan is now standing at the brink with survival far from certain. The failed Honda merger wasn't just a missed business deal, it was a warning about the dangers of pride and inertia at the top. In the aftermath, Nissan faces massive layoffs, shuttered factories, and no clear turnaround. Even with announcements of new hybrids and EVs, confidence remains low. The $50 billion debt load continues to suffocate operations, and no substantial profits are on the horizon. Industry observers, analysts, and even long-time rivals agree. The opportunity that Honda presented could have given Nissan a second chance. Instead, that window has closed. MacroAxis's assessment of a 100% probability of bankruptcy is a stark verdict. While Nissan's leadership tries to project optimism, the market is unconvinced. The latest restructuring, 20,000 more layoffs, rushed product launches and asset sales seems less like a recovery strategy and more like a final effort to buy time. The auto industry has always punished indecision and arrogance. Ironically, as Nissan faltered by betting solely on EVs and ignoring hybrids, Honda thrived by going against market hype and doubling down on hybrid technology. In the end, Nissan's story is a hard lesson for automakers everywhere. When survival is at stake, pride can be the most expensive mistake of all. Are you watching from the UK? Have you owned or driven a Nissan here? Tell us your thoughts. How do you see Nissan's future in Britain? Don't forget to subscribe for more in-depth UK car stories and the latest industry news.